In this video, we delve into a critical topic that affects us all: why savings are trapped in today's economy, drawing parallels between the anticipated collapse of 2026 and the infamous crash of 1929. Both events were preceded by a period of economic exuberance, where optimism masked underlying vulnerabilities. In 1929, rampant speculation and over-leveraged investments created a bubble that ultimately burst, leading to widespread financial ruin. Fast forward to today, and we see similar warning signs: escalating debt levels, inflated asset prices, and a disconnect between market performance and economic fundamentals. Understanding these historical events is crucial for safeguarding your personal savings. By examining the factors that led to past collapses, we can better navigate the current economic landscape and make informed decisions about our finances. Join us as we explore these significant moments in history, uncover the lessons they hold, and discuss strategies to protect your hard-earned savings from potential pitfalls. Stay tuned for an engaging and informative journey through time and finance. The economic landscape leading up to the 1929 stock market crash was characterized by rampant speculation and excessive leverage. In the years preceding the crash, the United States experienced a post-World War I economic boom, which fueled a sense of invincibility among investors. Many individuals poured their savings into the stock market, often buying on margin, borrowing money to purchase more shares than they could afford. This practice created an unsustainable bubble, as stock prices soared far beyond their actual value. When the market finally began to correct itself in late October 1929, panic ensued. The immediate effects were devastating. Millions lost their life savings as stock prices plummeted, leading to widespread financial ruin and a deep recession. Today, we see echoes of this historical collapse in current economic indicators, such as rising debt levels and inflated asset prices. By recognizing these parallels, we can better prepare ourselves for potential risks and protect our investments from a similar fate. Understanding the past is essential for navigating the future. As we analyze the current economic situation in 2025, several key indicators suggest a growing instability that could lead to a collapse. Inflation rates have surged, eroding purchasing power and straining household budgets. Simultaneously, unemployment rates remain stubbornly high, creating a sense of uncertainty among consumers and businesses alike. These factors contribute to a fragile economic environment where confidence is wavering. Government policies play a significant role in shaping this landscape. While stimulus measures were initially implemented to support recovery, ongoing fiscal challenges and rising interest rates have created a complex scenario. Market behavior reflects this uncertainty, with volatility becoming the norm as investors grapple with potential downturns. In light of these risks, it is crucial for individuals to be proactive with their personal finances. Building an emergency fund, diversifying investments, and staying informed about economic trends can help safeguard against potential financial turmoil. By taking these steps, we can better prepare ourselves for whatever challenges lie ahead in the evolving economic landscape. When comparing the factors leading to the 1929 crash with those anticipated for 2026, several similarities in market behavior and investor psychology emerge. Both periods exhibit a tendency for excessive speculation, where investors become overly optimistic and disregard fundamental valuations. In 1929, this was evident in the rampant buying on margin, while today, we see similar patterns in cryptocurrency and tech stock investments, where valuations often seem disconnected from reality. However, there are notable differences in regulatory environments and economic policies. After the 1929 crash, significant reforms were implemented, including the establishment of the Securities and Exchange Commission, SEC, to oversee market practices. In contrast, the current regulatory landscape is more complex, with ongoing debates about the adequacy of oversight in rapidly evolving markets. The lessons learned from the 1929 crash remain relevant today. Understanding the dangers of speculation, maintaining a diversified portfolio, and prioritizing sound financial practices can help investors navigate the uncertainties of the modern economy. By applying these lessons, we can make more informed financial decisions and potentially avoid repeating history, often leading to significant psychological impacts on saving behavior. During financial crises, Fear and uncertainty can cause individuals to withdraw their savings or avoid investing altogether, fearing further losses. This reaction can create a cycle of panic that exacerbates the economic downturn. For example, during the 2008 financial crisis, many people saw their retirement accounts plummet in value, leading to a loss of confidence in the stock market. Similarly, in the wake of the 1929 crash, countless individuals lost their life savings, which resulted in a long-lasting aversion to investing for many years. In light of these historical lessons, it is crucial for viewers to assess their own saving strategies. Are you relying too heavily on volatile investments? Do you have an emergency fund in place? By evaluating your financial habits and making necessary adjustments, you can better protect your savings from potential economic downturns and ensure a more secure financial future. Taking proactive steps today can help mitigate the impact of future crises. Safeguarding your savings against potential economic collapse requires a proactive approach and practical strategies. One of the most effective ways to mitigate risk is through diversification of investments. By spreading your assets across various asset classes, such as stocks, bonds, real estate, and commodities, you can reduce the impact of a downturn in any single market. This strategy helps ensure that your overall portfolio remains resilient during turbulent times. Additionally, maintaining an emergency fund is crucial. Having liquid savings set aside for unexpected expenses can provide a financial cushion during economic uncertainty. Aim to save at least 3 to 6 months' worth of living expenses in a readily accessible account, allowing you to navigate financial challenges without resorting to high-interest debt. Finally, staying informed about economic trends is essential. Regularly monitor market conditions and economic indicators, and be prepared to adjust your strategies accordingly. By being proactive and adaptable, you can better protect your savings and position yourself for long-term financial stability, regardless of the economic climate. In this video, we've explored the critical issue of how savings can become trapped during economic collapses, drawing parallels between the 1929 crash and the anticipated challenges of 2026. We discussed the psychological impact of financial crises on saving behavior, the importance of diversification in investments, and the necessity of maintaining an emergency fund. By understanding these risks and implementing proactive strategies, you can better safeguard your financial future. We encourage you to engage with our content by subscribing to the channel, liking this video, and sharing it with friends and family who may benefit from these insights. Your support helps us continue to provide valuable financial information. Additionally, we invite you to explore related content on our channel or website for further learning. Whether you're looking for tips on investment strategies, personal finance management, or economic trends, we have a wealth of resources to help you navigate your financial journey. Thank you for watching, and we look forward to seeing you in our next video.